All right, well, I'll get started with my introduction and then we'll jump into it in a few. Thanks so much everybody for joining us. This is our JUMPinar series. If it's your first time, this is our time where we go into special topics of real estate development that we don't necessarily have time to cover in our official training program, and that's our Jumpstart Germantown training program. We just started our winter 2024 program yesterday, and our second session is tomorrow, so we're excited about that. And those are in-person classes at our office, and I think I even see quite a few names on our attendees list that are enrolled in that class. So it's great to see you, and thanks for taking note of tonight's JUMPinar. So like I said, this is kind of our opportunity to go into a deeper look into topics that we can kind of skim over or don't have time to fully dive into during our training program. And this is a particularly important topic for new developers in finding financing. And we go over property sourcing, we go over setting up your team and getting an LLC and finding and sourcing deals. But the big part that Jumpstart takes a pretty big initiative with our loan program on is the financing aspect. And our Jumpstart Philly loan program, we like to imagine that we're a one size fits all loan, but the reality is we're not. And there's a lot of deals out there that we can't fund for one reason or another, and we'll get into the specifics of that and kind of explain exactly what fits a jumpstart loan and what doesn't, and what options are out there for those projects we can't finance. But also, with that same breath, we understand that you might not want to use Jumpstart for any reason, even if the deal does work for us. It's your decision as a developer to choose someone to help finance your project and choose your team members. So we definitely want to expose you to the options that are out there and get another speaker in front of you to hear their perspective. So yeah, if there's any questions about Jumpstart or our training program or loan program, feel free to shoot a question in the Q&A there, or email me. I'll put my email in the chat. But otherwise, we'll get started with tonight's JUMPinar, which is on alternative financing options. And my guest tonight here with us is Chris Tereo, and he works with iFundCities, and he's an expert on hard money lending, and he's going to be sharing a lot of what they do and the work that they focus on, and how it can help you out as a jump starter leaving the Jumpstart training program, or just joining these JUMPinars and starting to learn about the different financing options that are out there. So first, I just want to turn it over to Chris so he can introduce himself, and then we'll jump into our planned discussion for tonight.
Yeah, that's awesome. I appreciate it, Derek. And first, foremost, thanks to Derek and the Jumpstart team for having me on here. Again, my name is Chris Tereo. I'm one of the founders of iFundCities. We are a direct alternative lender. So what that means is we fit in between banks and hard money, right? So it's a fancy way for saying institutional alternative capital. And I'll get more into what that means, but essentially we provide working capital to real estate investors, likely a lot of you on this phone call, and we differ from banks and traditional hard money. So we fund mainly 1 to 4 unit residential, but that includes fix and flip, fix to rent, bridge only, purchase, cash out refi. We do the rental loans, the DSCR, which you've probably heard. And we do a lot of ground up construction too, townhome development, build to rent. So we'll get into all that stuff, but that's a quick overview of who we are and what we do.
That's awesome. Great. Thank you, Chris. And just one last housekeeping thing. If you have a question for Chris tonight, we're going to do a 15-minute or so Q&A towards the end. So right around 7:40 or 7:45, we'll switch over to that. So feel free to put your questions in the Q&A tab there. I see somebody has their hand raised, so we're going to do everything through the Q&A, so make sure any questions go there. And the chat will be closed just for now, but maybe later on we'll have it opened up for people to comment on the discussion. Okay, so just to open things up and kind of, if anybody on the call isn't familiar with Jumpstart, we are a hard money lender that works to finance people's projects, acquisition and construction projects. We also have construction only, but for the most part, all our loans are the same format. We have the same max loan amount, affordability restrictions, geographic requirements. So just to go over those quickly, and then I'm going to hand it over to you, Chris. We do have a $350,000 max loan size plus 50,000 per each additional unit. So if it's duplex, 400,000, triplex, 450, and so on. We do have affordability restrictions that are in place per our lender. So, you can't, for example, you can't sell a 3-bedroom home for any more than what is affordable to 80% of the area population. There's a chart on our website you can check out. Same thing with rent. We also have a strict locale where we can only fund projects in the city of Philadelphia and nothing out in the suburbs or any other city center. We do have equity requirements, so you need to always bring typically 15% of the deal in cash upfront as your initial investment, unless you own the property where we would fund 100% construction only. We must have a rehab aspect of the deal, right? So no turnkey rental projects or anything where you're buying and then flipping without improving the value. And then lastly, we have you must have a residential use. So we do commercial mixed use projects, but we wouldn't fund for a commercial only use, like a storefront only or a warehouse or anything like that. And then I lied. One more thing is our approval threshold requirements, which means that we don't approve any deal that doesn't have a 20% net margin on the sale or a 1.25 debt coverage ratio as a rental. So that was a lot of information. And just a reminder for people, you can go to jumpstartphilly.com if you want to review any of our loan terms and details and stuff. But pretty much every loan application that we get falls into that bucket, right? Either a buy and hold, buy and sell project, and with those same loan terms. But that's not the only type of project there is, right? There's a lot of different ways you can develop and things that you're seeking financing for. So I'm going to turn it over to Chris real quick and just, Chris, if you could explain different financing options that exist outside of Jumpstart, right? And we'll go into iFundCities in a minute, but just tell me about take off your lender hat, right? And if you were a new developer looking for financing, what options do people have out there?
Yeah, it's a great question. So if you're a first-time investor, there's two sources of, like, when you look at a capital stack, right, in a deal, that means like all the money that you're going to get to fund the deal. There's debt and equity, right? So lenders like iFundCities, Jumpstart, banks, hard money, they typically provide the debt in a project in a capital stack, and then you as the investor, you need to come up with the equity piece. So that's what Derek was saying. They require 15% of equity, right? And we also like skin in the game equity. We go up to 85, 90. So again, that 15 to 10% equity in the deal. So what's out there is debt. You have traditional, banks, right? And you're seeing a mass consolidation in the market. So that type of capital is harder to come by right now. You have alternative lenders like iFundCities, which we'll touch on, which I would put Jumpstart as pretty alternative. There's not a lot of Jumpstarts out there. You have hard money. Hard money is typically the most flexible, I would say, because it's usually a high net worth individual who is local to where that real estate project is. They like the deal. They like you as an investor, as a sponsor, and they're comfortable lending maybe over what a national lender might do. They might also be quicker because they're like, well, I know this area, I don't need an appraisal.
Right.
They're also limited because they're one individual and they do not have access to institutional capital or big capital partners. And then you have private lending. So that's true, like friends and family, and that could go one of two ways. They could fund 100% of the debt on a project. You could pair that with debt. So you could raise 15% equity and then go get a loan with Jumpstart or iFundCities or a bank. Mm-hmm. Where that comes into play, where an iFundCities or a Jumpstart, we're going to lend higher leverage versus a bank. So that equity gap could go from 30% to only 15 or 10%. And that's sort of the gamut of lending that you want to focus on.
Yeah. And I like the way you described it as there's a stack of capital, and it doesn't all need to be coming from one place, but
right.
You can get creative at what different options of this financing strategy you're using.
On the flip side, you could fund 100% of it cash.
Right.
So all equity, no debt, right? So there's multiple ways.
Exactly. Yeah. And I'm sure for a lot of first time investors, a big stack of capital isn't hard to come by. So you got to get creative in the way you're leveraging that capital and, like you said, deciding whether you want to build equity in the property or take on the debt. So I agree. iFund Cities and Jumpstart are definitely alternative financing options. And while there might not be a lot of Jumpstarts out there or a lot of iFund Cities, there's a lot of options similar, that might fit a different project category. So be sure to do your research and learn more about all these options because there's no connection that's not worth making, right? As it might lead to some possible financing of a deal down the line. So Chris, why don't you tell us a little bit specifically about iFund Cities in the terms of your specialty, sort of what types of projects are you funding the most often, and where do you fit in
Yeah.
sort of at like the role of financing for a developer?
Yeah, great question. I'll first start by saying a little fun fact. iFund Cities originally started as iFund Philly. So
Oh,
it started
hi.
myself, my partner Ryan Herding, and Brian Ziegenfuse. So we started doing just investors, developers that we knew in our network. Started lending there, and then we started to do some loans in Pittsburgh and New Jersey. And the name iFund Philly didn't really stick too well, so we
Right.
had to come up with something different. So we do lend nationally with a few states. Like we don't lend in New York or Nevada, but where I would say we really fit well in investors capital stack and can help grow and scale someone's business. So, really after that second, third deal, and you get to 4 deals under your belt, not to say we won't fund a first time or second deal, but our capital is better suited for the more experienced investor. And what I mean by that is we're able to leverage your experience by giving you access to a wider variety of lending products
Mhm.
and at higher leverages and
Mhm.
lower cost of capital, right?
Mhm.
So, as someone who maybe does their first flip, that's awesome. You take the proceeds, roll it into your next deal, and eventually maybe you do 10 of those and you're great. Maybe you want to stay in your lane, and that's awesome. Great. We would love to fund some fix and flip stuff, but if let's say you have a new construction deal and it's $500,000, maybe it's $1 million, and
Mhm.
you're like, I can't use the funding I've been using today, or my private lender is tapped out. He or she only has $700,000 they can lend me.
Mhm.
That's where we fit in, and we say, hey, we look at your FICO, we look at your experience, and we get comfortable with the deal, and we say, hey, we'll fund you 85% of this project in debt,
Mhm.
and you only have to raise 15% of the equity or put 15% of your own cash in that deal.
Yeah,
So
yeah,
iFund Cities really specializes in, I would say, heavy rehab, new construction, as well as the rental DSCR loans, like the takeout loans, if you're holding
yeah.
them.
Yeah, that's cool. And I like having this discussion in juxtaposition with Jumpstart because I think we're like it sounds like you trade off the experience requirement for being able to provide flexibility, right? You're like since we know you're experienced and we understand that you can get this project done, we're able to kind of make our product fit for what your needs are, right? On the
Yep.
other hand, Jumpstart, we're heavy on the training. We have our own training program, and we're very forward about lending to people's first time projects and teaching them through those learning phases.
Yeah.
We can't be flexible with our loan, right? We can't we don't have like any changes in our terms for people who've done 50 projects versus one project. Um,
Right.
and I think that's a great point where like you know this your loan product or other hard money lenders like that, just because they're not looking for you or just because they're looking for you to be experienced doesn't mean they don't want to work with you as you're a newcomer. They're just looking for that like that ability to kind of help you reach your goals, you know what I mean?
Yeah, that's a great point. And I said this to Derek last night for everybody listening. I never say, hey, how do we fund every single deal that you're doing? As an investor, you need to build your team, right? And
Mhm.
that includes everything from a lender, architect, GC, legal team, right? And then in that lending team, you should have multiple lenders, right? You should have a really good local banking relationship. You should have an alternative lender like Jumpstart to do your AMI projects, smaller projects in the neighborhood that make a lot of sense, are going to move super quick. And then an iFund Cities who will allow you to grow and scale that business to maybe if you want to do something outside of that market or little bigger projects.
Hmm.
So it's all about building that team of lenders.
Absolutely. Yeah. So before we jump into, I guess, some of the specific loan formats and options you guys offer, can we talk about some projects you funded in the past and maybe just, any of your favorite projects you've seen come to completion through financing with iFundCities?
That's a hard question, man. There's a lot of projects that I love. First of all, I love real estate. I started as an investor. I still passively invest myself. I would say the stuff that I love the most is honestly the new construction stuff is fun, right? Like you get to build from scratch, and a lot of times you run into like higher price point stuff. Like we do a lot of stuff in South Florida, and it's you get into some of the luxury stuff. But honestly, I love, if I'm speaking as a lender, I would say I love the Philadelphia or New Jersey. You buy it, you fix it, you renovate it. Or sorry, same thing, renovate it, rent it out, and refi. Because for us, it's like our one-stop shop. We could help
Yeah.
you with the purchase, reno, and the refi.
Right. It's reliable, I feel like. Yeah. It's
Yeah,
a
it's real.
tried and true
Yeah,
strategy.
down the fairway. We know how to do it. We do it well. That's the stuff I love.
Cool. That's great. And you mentioned you're lending nationwide now. So are you mainly in like urban centers? Are you working in different smaller cities or what?
Yeah, another great question. So we have what we do is like so our headquarters in Philadelphia, and we have the underwriting team, processing team, construction management. So we do all this stuff in house. Then we have inside sales reps there too to help support Philadelphia and the surrounding region. But we also around the country we have local territory sales reps. So a lot of times right now, especially, you have someone from Philadelphia and they're like, hey, I'm thinking about investing in North Carolina. We say, great. I'm going to connect you with Eric Eichinger, our local, territory manager down there. And it makes a huge difference. Or when you're trying to do a loan in North Carolina and you're in Philadelphia,
Mhm.
right? It makes a huge difference when you can actually walk on site, see a project, shake their hand, and really build a true relationship. So I think that's what, as a company, we've done well is
Yeah.
building that local boots on the ground nationally. Now it's not like we have an LO in every state,
Yeah.
but we have I think eight national reps in various markets that we're hyper focused on.
Cool. Cool. That's great. Okay, so in terms of the loan formats and options you guys offer, right? So back to what I was saying about Jumpstart, when we get a loan application, it's kind of falls into two buckets. We have buy and hold and buy and sell.
Yep.
Slightly different underwriting processes for the both of those, but for the most part, same loan format, same terms and everything. With iFundCities, when somebody's coming to apply for a loan for you, what are they picking from? Are they telling you, this is a new construction loan, look at it this way, or are they kind of bringing all the information into you and then you decide?
Yeah. Yeah. So we always, and again, we do work with, maybe this is their, second to fourth or 100th deal, right? So we do rely on them to tell us, okay, hey, what are you looking at here? What's your goal? What's your exit strategy? And I think one of the reasons why we work together well, like we complement each other well, Derek, is we have a lot of the same underwriting, practices. So we also look to see a 680 FICO. Having said that, we can go lower. We could do a 660 or 650 with a letter of explanation. So there's ways, but we do love a 680 FICO score.
Is
The
that
DS
is that
good.
680 credit score required even if you're like flipping it, or only if it's a rental?
Um, no, I mean it is both. So 680, it's just hard to get good terms below
Yeah,
a 680 on
sure.
the rental loan stuff. That's harder to sort of, get through bridge loans. There's more flexibility, but we do look to try to keep it above 680. But again, like let's say your partner is a 780 and you're a 650 because you put a lot of stuff on your credit card for this project. That's where we're able to work with you. So it's not like a set in stone. You know what I
Yeah,
mean?
makes sense.
Yeah. So yeah, besides that, we underwrite the deal as a lender first and say, okay, what's your experience? We look at our matrix basically. So we say experience, FICO score, liquidity. Those are the three things. Again, experience, FICO score, liquidity. That's what we care about. We don't look at tax returns.
Mhm.
So we verify experience, saying how many previous projects have you completed that are similar to this one?
Mhm.
FICO score, do you pay your bills in a timely manner? And liquidity, we don't look at tax returns. we take 2 months most recent bank statements. It could be one account or 10 accounts to see the liquid cash required to do this deal. So it's very like common sense, can you do this deal? Do you have the money to do this deal? And then we underwrite the deal itself. Does this deal make sense? You mentioned 20% profit margin. We're right there. We're at 15%. If it goes below that or it's at 15, we start asking questions. Hey, are we missing something here? Maybe it's a rental, stuff
Yeah.
like that.
That's great. Yeah. So again, sounds very apples to apples sort of with Jumpstart. But I also want to learn a little bit more about, so for a new construction loan, is there terms
Yep.
different or the process different than a rehab project?
Yeah, good question. So new construction is typically a little more expensive. If we're just talking rate, you could factor 25 to 50 basis points more expensive. It's only because cost of capital for new construction is more expensive.
Yep.
But
I
the underwriting itself really isn't too much different. Besides, maybe we'll get, we require, if it's a purchase, we definitely need it to be shovel ready. Let's say you own land and you're refining it into construction, we look to at least have zoning approval, like
Right.
zoning permits.
Right.
um Maybe we get a feasibility to make sure that if it's a very big construction budget, I mean, we do loans up to $3 million. So if it's a really big project, we're going to get a feasibility. If it's multiple units, maybe a phase one, like stuff like that, that
Yeah.
you just don't need for fix and flips.
Yeah, that's great. All great information. How about the construction budgeting side of things? What are you requiring folks to tell you up front about, like, are they giving you scopes of work and contractor estimates, or are you kind of getting to that later down the line after the project's been approved?
Yeah, I mean, if we're just having a conversation, you call me up, say, "Hey, Chris, I got a new construction project." I'm not going to require all that info to run it down. You give me the purchase price or what you bought it for, the
Yeah.
rough construction number and the ARV, and I'll be at the after repair value, and I'll be able to tell you roughly terms based on your experience, FICO, liquidity. Once we have a signed term sheet, we definitely want to see a line item budget. It's only going to help you, right? When you submit draws, the more detailed a budget, the easier that draw process is going to be. But yeah, there's little things like with new construction, we're going to probably require a 10% contingency because you never know what's going to happen. Nothing ever goes according to plan in real estate. So little things like that are different.
Yeah, got it. Makes sense. And then the last, I guess, loan format I want to ask about is for long-term financing. So Jumpstart, we stop after that 12-year, short-term
Yeah.
acquisition construction financing. And then we tell folks, go find someone to refinance with, and pay our loan off, whether that be your credit union or another hard money lender or a traditional bank loan. I think it's really great that your product is kind of has both, so side by side, right? So, when you secure your short-term financing, there's a refinance right there waiting for you. But tell me a little bit about your long-term financing options and what do you offer for, like, stabilization of properties?
Yeah. Good question. So it looks and feels more like a conventional mortgage, right? So typically it could be a 30-year fixed, fully amortizing, 30-year amortization. It's heavily driven by LTV, right? So are we doing 75% cash out? Are we doing a 60% rate in term or a 60% purchase?
Mhm.
So that affects the rate. Is it a cash out versus purchase, or are you just swapping debt like a rate and term? FICO score heavily drives the pricing on the rental loans, whereas experience is really the biggest driving factor in the construction and bridge side. FICO score is the biggest on the rental side. And then prepay penalties.
Yeah.
So if you are doing a rental loan and you're not quite sure what your prepay penalty is, then make sure you ask your lender. Um, Very common is a 5 4 3 2 1, which means, if you were to pay that loan off early in the first year, you pay a 5% penalty. In year three, a 3%, and then in the fifth year, 1%, and then it burns off. So I always tell people, I ask them, like, hey, what's your goal for this property? Do you just want to hold it for 30 years, give it to your kids one day and never think about it again? Then great. Let's go get you the lowest rate possible. Put a 5 4 3 2 1 on there. You'll probably reposition it in 10 years anyway. If you're like, yeah, I want to hold on to it for a couple of years, but then I might sell it. And I say, okay, then maybe we should do a 3 2 1 prepay penalty. And the reason why I'm still suggesting the prepay penalty is because it buys you the best rate possible. So it's first important to understand what your goals are for the property, right? And then you come to, someone at iFundCities and we tailor the loan to fit your needs.
Right. Yeah, that's great. Sounds great. And just to go over that FICO score requirement, so you guys are doing a hard credit pull?
Yeah, so we do a hard credit pull. Definitely the first time we do a deal, it's good for 90 days. We do soft pulls in between. Um, so yeah, we try not to impact the credit score. If you're, especially if you're doing volume, and
Yep.
like we have some guys and girls that do 5 deals a month with us, and we're not hitting them on their credit
Right.
score hard
Right.
pull.
And I think it's important for folks to remember because that's always the thing that people ask us about. They're like, "Do you do a hard pull?" And we would just require them to send us documentate like a credit report they download. But I think that the trade-off in your situation, right, is this person is experienced and they should have a solid credit history and they shouldn't mind a hard credit pull, right? So I think in a situation like ours, when we're lending to somebody for their first project ever, like we understand that credit might not be the greatest, right? You might be working it towards that, or maybe our project will help you get the credit to that range. So I just want to reiterate that because I think a lot of people hear that and think, oh my God, they're going to screw up my credit. And it's going to be awful. But there's a reason you do that hard pull, right? Is because that inquiry means something, right?
Yeah, and one thing I did want to mention too on our
Yeah.
rental loans, which is super popular. Um, so we do the short-term rental stuff, and a lot of times it's hard to make that pencil if you can't find the short-term market rents. So we can still get deals done using monthly rents. And what we'll do is just solve for a lower DSCR, debt service coverage ratio. Our minimum DSCR, we really like to be at a 1.15, but we can go down to a 1, which basically means you're breaking even. The reason being, rates are high and we know that you're probably going to reposition at some point. Maybe we do an IO and it's more like a shorter term, long term loan, like a shorter term DSCR loan. And sometimes you're doing a short term rental and the rents aren't actually going to be reflected on that DSCR.
Right. How about borrower documentation? I'm assuming you're open to lending to LLCs. Do you do loans with individuals?
Great question. Yeah, no individuals. So it has to be in a business entity. So LLC most common, LP, corporation, trust,
Gotcha.
S corp, whatever. Yeah,
So is that to say, so are you mainly investor focused, or do you ever lend to people for, personal home buying options?
100% investor focus.
Got it.
We don't do any
Got it.
personal
Got it.
loans.
Cool.
Yep.
Should have been one of my first questions. Um, okay, so the next thing I want to talk about is your underwriting process. So, if people don't know, underwriting means sort of like the lender's approach to analyzing the deal and deciding, what their terms are going to be or whether or not they approve it or not. Uh, Chris, if you could tell us a little bit, about how you guys analyze the deal and what you think new investors should be prepared for in terms of like their communication with the lender throughout that underwriting process. There's a lot of question and answers and back and forth. I want to know, what do you do to make sure that this is going to be a solid investment outside of those things that you mentioned, like, the credit score
Yeah.
requirement, the proof of funds, that sort of thing.
Yeah. Well, you asked what they should look for, anticipate, and just anticipate that everything's going to go wrong because that always happens in real estate, first and foremost.
Right.
Um, No, but we look at, again, like, as far as the sponsor stuff goes, we know we look for experience, FICO, liquidity. As far as the deal, the most important thing right now that we're looking for is cash, right? Because once we originate a loan, it's not like, hey, 8 months from now we run out of money. Can you give us more? That note is like sort of set in stone, right? So like the only way you're going to get out of that is raising more capital or infusing more cash yourself. So you need working capital.
Yep.
That's probably the most, I mean, cash is king. That's probably the most important thing right now.
I'm glad you said that because I think there's a misconception when people think especially in hard money lending, right? They're like, I have my 15%, I'm set to go. That's going to go towards closing. But they don't
Yep.
realize sometimes there's that first 10, 15%, 20% of the project that's going to need to be funded out of pocket,
Yep.
right? So
Yep.
and that leads to another good question for you. Are you looking for like a specific dollar amount there, or are you kind of just saying like, here's the construction budget, I'm estimating the first deposit is going to be this. What do you do there?
Yeah. So we do back into a like required liquidity amount. So it's your cash, your estimated cash close, which is, lender fees, title, taxes, insurance, all that stuff.
Mhm.
We also like to see 6 months of like interest reserves liquid at the time of closing. And then, depending on experience and if you already have contingency built in, how big it is, we also like to see 10% of the budget liquid. So
Yeah.
it's not just like, hey, I have $30,000 and I know I can close this deal. Like, we've backed into, you really need $50,000, at least based on our minimum loan size, to really successfully, with being able to sleep at night conscious, like do a deal the right way.
Right. Yes. And again, with Jumpstart, like we don't have a solid number that we look for you to have, but we know that that's going to be a barrier, right? Is like before you get started on this project, you're going to need to bring more money out of pocket. So I think stressing that as much as you can to people is great. So thanks for bringing that up.
Yeah.
Um, so let me get my notes here. So yeah, that your underwriting process, you said, kind of contingency, assume everything is going to go wrong, which is a great point. Obviously the flexibility and the working capital is important. How about for I think you mentioned earlier that you look for that 15% net margin on the debt coverage ratio side of things. Are you looking for a 1.25 or higher or lower, or what's
Yeah, we're looking for a 1.15. But
1.1?
like I said, we will go below 1.15, like in the cases of, maybe it's just the margins are skinnier, but maybe it's a short-term rental and we're using long-term rents. So we are flexible there. And we look at gross rents minus insurance, taxes over your monthly payment. So we're not taking out for OpEx. So it's pretty hard to not meet the DSCR
Yeah.
requirements.
Yeah, definitely. That would change our underwriting a lot if we took that out.
Right. Yeah.
Yeah, so okay, and then I guess my last question before we jump into a little graphic that I think you wanted to share and walk through for folks. Could you just tell us a little bit about the application process and what it takes to get to the loan approval and the term sheet for, somebody who might have heard you on tonight's webinar and thinks, they might be able to finance my next project. What's their first step? Where do they go? What can they expect?
Yeah, absolutely. And I'll make sure that we get all of this, afterwards. Like the easiest way is go to the website, check it out. We do have a form that you could submit via the website, but honestly, give us a call. Like we love talking to real estate investors. We mean it. A big sign in our office, built by investors for investors. We have a real passion. So if you have a project you want to run down, give us a call. You can shoot us an email. I'll make sure that I give a list of our loan officers and
Yeah.
their areas, but feel free to reach out to me. I'm on the phones all day. Would love to talk to you guys. But yeah, it would honestly be call in. We'll have a quick 5-minute conversation. We'll ask you a couple questions. If you have a current deal, like a live deal, we'll run it down right on the phone and send you like some high level email points. And if you want to move forward, we could send you a term sheet that day. So
Yeah.
it's pretty
Okay.
easy.
That's great. Yeah, that's great. And I like the just kind of contact and attack sort of approach. So,
Yep.
how about, and I know this is going to be one of our questions in the Q&A, how quick can you close?
Yeah. So we've closed as quick as, 5 business days. And that's like if someone comes to us and say, hey, I was going to do this deal with someone else, or I was going to fund it cash, but I'm in a pinch. I have appraisal, I have title, I have my insurance, I have all my entity docs, and like I get a full package. We
Yeah.
are not really a company that closes in 5 days, but we will.
Okay.
I would say we're like a 2 to 3 week, maybe 2 to 4 week closing timeline. And everybody feels good. Loan docs aren't
Yeah.
late. No one's
Right.
screaming at anybody. Everybody's
I,
happy.
I had to get the chance to ask you that question because I get it too often, and I feel
Yeah.
guilty saying 5 days because I know that's what people are going to expect, right?
I
But
know.
yeah, thanks for your honesty there, and I think what we say is it's really as fast as the borrower is able to work, right? So as fast as they're able to get their documentation in time and get things rolling, you should be able to follow suit.
You nailed it. As we can close as quickly as you allow us to. You
That's
nailed
great.
it.
Cool.
Yep.
All right. Well, let's take a couple minutes if you want to share your screen and pull up that graphic. Just
Cool.
because I think that was a cool concept to go over. And
Yeah.
really
And
talk through.
just yeah, and just so everybody knows, before I pull this up, the reason why I'm pulling this up is, Derek and I were talking, and I think it's really important to understand, why come to iFundCities and not a bank or another lender or Jumpstart, and to take it a step further, like where does iFundCities get their capital, right? That's a question you should ask every lender, because it might be a broker, it might be, and there's nothing wrong with any of these options, but it might be a broker, it might be hard money. And what you're going to get out of that is, okay, they might be limited. They might not be able to support me on a townhome development project, or they're not going to be able to the best fit as a smaller fix and flip in Philadelphia. So it's really important as the investor to ask these questions and find out where the capital comes from. Because like we saw in COVID, a lot of lenders shut their doors overnight, right? Banks drew back, other alternative lenders. So anyways, let me share my
Yeah.
screen and go through some of this.
Yeah, that's great. And I want to remind everybody after this, we're going to have a quick Q&A. So be sure to enter your questions into the Q&A tab on Zoom. Thanks for those who have submitted ones so far. And also thanks for everybody for joining us tonight. We have a great audience of 70. So I'm really glad everybody's.
Love it. I wish I could see everybody's faces, but
I know, but 70 faces would be too much. Let's be honest.
yeah, that's true. That's true. That's hard to manage. All right, Derek, I'll rely on you. Can you see this?
Yep, I see it.
All right, awesome. So it's nothing crazy, guys. What I just want to do is paint the picture of, institutional capital really and where it comes from. So, on the bottom here, and not to say investors, developers, and builders are on the bottom. In fact, I'm on this floor. I love investing. I'm simply saying that this is the like boots on the ground. You are building the real estate from the ground up, right? Where you're going to go get your capital, you're either going to go up a rung right here to a loan broker, or you're going to go up here to a direct lender. Now, in the direct lender bucket, you have local banks, you have hard money, you have iFundCities, you have Jumpstart Germantown, right? So you have all these direct lenders. A lot of people will go to loan brokers, whether it's your first deal or you're on deal number 100. Loan brokers are great assets when it comes to financing because maybe you're a developer and you straight up just don't have the bandwidth to go find your next loan or find your most competitive pricing, right? And they serve a time and a purpose. But what they're going to do is go shop out the best of these guys right here. So as an investor, it's important to know, hey, first of all, am I dealing with a loan broker or am I dealing with a direct lender? Especially when you want to get, straight answers or, qualify. Again, nothing wrong with loan brokers. We work with loan brokers. We love them, but I'm just painting the picture of the capital right here. So direct lenders, and I'm going to focus on iFundCities here because this is more of like an institutional chart. So assume, iFundCities is a direct originator, right? So that means we're lending you money off our own balance sheet, right? And you're coming directly to us or through a broker. What we're going to do with that note and what other lenders do is, we either hold it on duration on our balance sheet, or other lenders in the market, they'll sell to at note aggregators, which eventually get put with hedge funds, private money, or private equity. And, eventually it's all funded by these insurance companies up at the very top. So the reason why I'm showing you this is where cost of capital comes from, especially in the alternative lending space, banks. It's all driven off of, the market. The key, did you want to say something?
I'm asking, is it too simple to assume that as you move down this pyramid, the cost of capital increases?
Yeah, that's a little too set. I mean, obviously, like if you're paying a broker on top of your loan,
Right.
like you're going to pay more. It's more
Right.
expensive.
Right.
The biggest key is what direct lender are you and where are you getting your capital? So the biggest thing for iFundCities, I always say it's not like we found a way to reinvent the wheel. What I think we do really well is we've been able to skip over this like aggregator step, and we work directly with the hedge funds. We have a few very strategic capital partner relationships, which gives us the best cost of capital and a wide product variety. And what they do is they just manage life insurance and all the insurance company money. That's where all this capital comes from. So again, I know this is, if you're not familiar with this, I'm happy to talk more about it if you want to hit me up offline. But I thought this would be a helpful sort of like where the capital comes from and why, in times, rates are going up, why rates are now 11-12% and they were 8% for construction money 2 years ago.
Yeah, that's great. Thank you very much, Chris.
Sure.
All right, so I'll jump into some of these questions in the Q&A, and if anybody has questions as they come up, feel free to type those in there. Um, and Chris, feel free to just rapid fire responses. If there's any clarifying questions, we can, ask them to send another one, and we'll get to it at the end.
Cool.
The first one here comes from Enna or Enya, and they say, in a competitive market, how fast is the turnaround for approval and then funding? So I think you
Yeah.
answered this. You said 5 business days is the very, very fastest, but 2 to 3 weeks is where you're comfortable.
Yep. And then approval could be in 5 minutes. So
Gotcha.
if you give us a call and you tell us everything, the hardest thing is if you tell us you have, a 780 FICO and 5 deals experience, but we actually get your experience and it's 2 deals and you have a 640 FICO, that's where we
Right.
run into problems.
Sure, sure. Yeah, just be as upfront as you can with the information.
Yep.
And then I meant to ask this earlier. How about inspection requirements? Do you come out and inspect the property, or do you send in a contract inspector, or is that kind of case by case?
Yeah, great question. So we have 2 ways. We know the draws are a pain point. So we have, yes, we can have an inspector go out and take pictures, and then they send us a report and we fund you. We also have an app where you take pictures yourself, or you have a PM, like a project manager. They take the pictures, get uploaded. We look at it, we fund it, and then you move on your way. It's usually a quicker process.
Got it. Cool. Kenneth says, thank you for the information. Basically, if iFundCities credit score based is 680 minimum, is this the same credit minimum for Germantown projects, or is there flexibility? So to answer my part of that, yes, we have a 680 minimum credit score for rental projects, but we don't have a minimum credit score requirement if you're buying and selling the property. We just still ask you to send us the report so we can take a look and make sure there's not like 20 accounts and collections and stuff. But and Chris, on your side, you're pretty strict at that at 680 FICO, right?
No, so our minimum is 660.
660.
And if we go below that, we need a really good reason to go below. Like, hey, I'm at a 650 or a 640, but I've done a bunch of flips, or I have all this cash, right? And there's a good reason for it. It's like, hey, it's just utilization on my credit card. It's not like you have 4 mortgage lates, right? That's a red flag.
Got it. And then Sophia is asking, which FICO score do you look at? 2, 3, or 8? I'm assuming.
Uh, yeah, we
FICO.
take the middle score. So we pull from all 3 bureaus.
Gotcha. Okay. And I think that's FICO 8 is like there's like different numbers of the scores.
Yeah, yeah.
I'm
I
not too.
could actually give you a better, yeah, I'll give you a
Yeah.
better answer, but it's still it's the middle score.
Cool. Sounds good. Next question is from Anna again. They say, do you lend in tri-state areas near Philly? So I think you say you don't lend in New York, but Jersey, Delaware, all good?
Yeah, we love Delaware County, but all the surrounding greater Philadelphia area, love Jersey, Virginia, Maryland, so Delaware. Yeah, basically everywhere except New York, Nevada, Hawaii, and Alaska.
Got it. Cool. And I'm going to jump in with a question because I don't see it asked here yet, but I need to know your interest rates. What are you what are you charging, or is that also case by case, kind of flexible based on what the situation is?
It is case by case. It's obviously the favorite question of a lender when you get
I
asked
know
that.
I was waiting for it to come up, but I had to
I
ask.
know. I was shocked, man. No, look, again, it's based on the experienced FICO liquidity. Is it new construction? Is it cash out refi? For the bridge construction stuff, I'll give you the general range. It's anywhere from 10 to 12% right now. But again, we're talking 85 up to 90% loan to cost, larger deals.
So kind of
And then the DSCR, that is pricing. I mean, that's kind of fluctuating right now. The market's sort of correcting right now. We're in the sevens, could be in the eights if it's like a super high cash out, low FICO score. So that's kind of,
but yeah, no, that range is super helpful just to kind of know where like where you lie. And we're similar,
yeah,
like with the we're at 9.96, I think, and that's sort of just fixed for anybody.
right.
But like you said, we have a lot more limiting terms, and you're able to kind of fluctuate with the loan to cost and some of the
Yep.
other terms to accommodate. So great to know.
Yep.
And good to know. You said for long-term financing, you're 6 or 7 right now.
Low sevens is kind of the best pricing right now.
Yeah,
Yep.
always good to know because on our like Jumpstart pro forma, that number that we use for the interest rate of the permanent bank loan, we're at 7.5 right now, just
Right.
because that's what we're assuming and we're hearing on refinance. We want to be conservative, but we're waiting for the day when you say something like 5 or 6.
Me too, man.
It'll make a huge,
That's
it will make a huge difference. Um,
right.
Okay, so next question here is from Luis. They say, Uh, the GP in the deal is in, I'm not sure what GP is. Do you know what that stands for?
General partner versus limited partner,
Gotcha.
right?
Gotcha. The general partner in the deal is an LLC with three members that have no residency. They're foreign people outside of the USA. Is it possible for them to get a loan for a new build? So, do you require residence in the United States?
So we do work with foreign nationals. We reduce leverage. They need to have a visa or a pet, like some type of like residency. They can't still live in Israel and invest in the United States. But yeah, I mean, if you want to talk, we can absolutely have a conversation. It's case by case. It's based on experience as well. So yeah, I'd be happy to chat further if you want.
Cool. Next question here comes from Stephanie. They say, depending on the deal, will iFundCities do a new development project if it makes sense and the developer has all the other qualifications except the experience of being a developer? So I know you talked about this at length, but feel free to give another answer.
Yeah, no, it's a good question, Stephanie. I without just saying flat out no, we do look at the deal like, hey, do you have the right, like a phenomenal FICO, a ton of cash? We have worked out deals where, like, especially locally, we do have a partnership with a few GCs or consulting companies where we can leverage their experience as the builder, and you as the investor don't necessarily have the execution ability, but because they're signed on the deal with you, we're comfortable funding the deal. It's not going to be the 85 or 90 loan to cost. Maybe it's 80 or 75, but we can still get that done.
Absolutely. Yeah, that makes a lot of sense. As long as there's someone on your team who has the construction experience, plenty of situations, I bring the sweat equity, you bring the finances. So, yeah.
Right.
Cool. Stephanie, thank you. Next question comes from Mark, and they say, will this be available after the meeting? Yes, we'll have a recording of this posted on our website, as well as we'll send out a follow-up email with some points from Chris's presentation, as well as contact information and everything in the morning. Victoria says, do you fund new construction? Answer is yes.
Absolutely. Yep.
Next one's from Sei, and they say, do you guys have a house refinancing after the deal is renovated for whole job? So that's what we were talking about, long-term financing. And Chris, if you just want to really quickly recap what your
Yeah.
long-term options are.
Yeah, we absolutely do. So it's called the DSCR 30-year rental loans, commonly referred to as a BRRRR. So you buy it, you renovate it, you refi, you rent it out, you refi it, and repeat. So we absolutely can do that. We act as a one-stop shop. We'll help you with the acquisition, rehab, and the refi.
Cool. And for those who are on the call that are also enrolled in our training program, we're going to go over BRRRR, the acronym BRRRR, which Ken's going to quiz you on what the acronym means. So make sure you Google that before that class. Okay, next question is from an anonymous attendee. They say, are owner-occupied multifamily properties considered an investment property? So for like a house hacking situation where you have a triplex, I live in one unit, my friends live in the two others, how would you look at that?
I mean, look, if you bought it in your personal name and you fixed it up and you added some value, then yeah, I would consider that if I saw that on your real estate experience. I can't say, okay, hey, I bought a property that was pretty much turnkey. Now I want to go leverage that and build new construction. We would need some sort of, similar experience on the renovation construction side. So I'd ask you, what did that multifamily property look like?
Yeah, that's great. So whether it's turnkey or not is a big factor there.
Yep.
Cool. Shavana asked, this will be my first deal, but I meet the other requirements. Should I keep your info for the future when I have more experience?
Absolutely, Shavana. Would love to work with you. I think Derek would be the best fit, depending on the deal size. If it's larger, let me know. See if we can work something out. But yeah,
Yeah.
absolutely.
Yeah, so Shavana will definitely get Chris's and the rest of his team's contact information out tomorrow, so you can put it bookmarked for later after you complete a couple deals with Jumpstart. Brenda says, can you explain what you're looking for in terms of liquidity? So from I look at that as proof of funds, right? Just showing that you have funds to close on the deal, and you're
Yep.
looking for that 15% plus some working capital, right?
Yeah, so it's to simplify it, it's cash to close, 6 months of IR, 6 months of interest reserves, and then 10% of the renovation or construction budget liquid. Those three things. And we look to see that in one bank account or multiple bank accounts. We could also use Robinhood or other liquid asset type things to see that cash.
Got it. Kenneth is asking, is there any funding options that could combine a VA mortgage into a multi-unit property that could be funded with one of these programs? It's a pretty nuanced question, but are you able to answer it?
Is there any funding options that could combine a VA mortgage into a multi-unit property that could be funded with one of these programs? If you're asking if we can combine VA with our debt, not we can't. For the main reason being we are always the first lien position. So we can't take a second, or I know like a VA, you wouldn't be able to have a VA loan in a second position either, most likely. But what you can do is if you have, equity or an unsecured line of credit or a HELOC on your personal, and you use that equity to go do an investment deal with our debt, you can absolutely do that.
Great.
Right. And one thing too, I didn't really touch on, a lot of people in this space, they ask me like, hey, is it okay if I raise money to do this deal? Absolutely. I would say 90% of the people that are successful here don't use a lot or all of their own cash. They're raising money. Obviously they're securing debt from an alternative lender or a bank or Jumpstart, but they're also raising that LP money, the equity. They're finding equity partners and they're giving them money to bridge that 15 or 10 or 20, whatever that equity gap is. And it is something I did want to touch on. The reason why it's really important to find a lender, especially now, to give you higher leverage versus maybe a bank or whatever the case is, that equity is either your own cash, so you're risking your own cash, or that equity is very expensive. It's typically, 10% preferred return plus a piece of the profits, or it's just a 15 to 20% straight up paid out preferred return. Versus debt, which, yes, 11, 12% sounds expensive, but not when you compare it to equity, which is a piece of the profits or, a 15 to 20% pref. So I just wanted to say, it's super important to look at your whole capital stack and run the
Yeah.
math.
Yeah, and similarly, I think with there's a misconception with jumpstart loans and other hard money loans where they see that high interest rate. They're like, interest rate above 10%, that's ridiculous. I don't know about your case, but in our case, we are monthly interest only, so we only require fixed monthly interest payments after construction is complete, right?
Yeah.
Are you similar? Do you start with fixed payments up front?
Yeah, so we do like kind of not dissimilar. Like, so yes, you start with like a monthly payment, depending on the transaction. If it's cash out, we can help you with interest escrow. But what's really important too, and I'm glad you brought this up, there's a lot of other lenders out there that, typically will charge interest on total loan versus dispersed. And that's really, really important to know as a newer investor. That basically means, let's say we're giving you $100,000 day one to go towards a purchase, but then we're giving you $200,000 in holdback, right, to draw down on slowly throughout the completion of the project. Some lenders will charge you interest on $300,000 from day one versus, we do drawn dollars and you're paying interest on that 100K. And then as you draw down more, your UPB, unpaid principal balance, you're paying interest on that. So when you actually run that math, it is a staggering difference on how much interest you paid.
Absolutely, great. That's cool, right? I think we meet somewhere in the middle, right? Where it's like we accrue interest as you received
Right.
it, but with and especially again like an experienced developer who's working with a lender like you should have the cash flow where a monthly payment isn't something difficult to make, right? I think
Sure.
when it's your first project and you've never done this before, you might be strapped for cash every month, getting the project done, paying contractor deposits, getting the work completed.
Yep.
So we try and offset those costs, but yeah, that makes perfect sense.
Yep.
Okay, we only have a few minutes, so I'm going to zoom through these last couple questions. First is from Ty.
Oh.
How do you confirm one's real estate experience? So, is there a resume or a portfolio that you request?
Yeah, we have a form. So we send it out. It'll basically just say, the address, the entity you bought it in, or whether it's your personal name, when you bought it, what you bought it for, what you built it for, what you sold it for. And then if it wasn't a flip or wasn't new construction and sale, then we say, what rentals do you own? So we take the sum of those and say, you have 8 deals experience,
Gotcha.
or whatever the number is.
Cool. Enya asks another question. What is the minimum size deal? Or I guess I'll put it this way. What is your minimum loan amount? What's the smallest sort of project you'd find? fund?
Minimum loan size is 75K, although I'll say it's really, it doesn't make sense for us to do those, same as it wouldn't for you, because we have a minimum origination fee of $3,000. So it becomes very expensive at a certain point. Again, like we can do it, but we're better suited for the 150 plus, 300K plus type deals.
Cool, makes sense. If you had to guess, like an average loan size, what people are usually at?
Average loan size for us is 450, but we've done a 75K fix and flip and a $15 million townhome development and everything in between.
Cool, that's great. Next question, or this isn't a question. Stephanie just says, "Thank you. This was super insightful and helpful. Thanks for doing this." Thank you for being here,
Awesome.
Stephanie. Yeah, happy,
Thanks,
happy.
Stephanie. Appreciate that.
Happy we're being a little helpful tonight. And the last question comes from Ty. He says, "Are there any docs required on owned properties when applying for the permanent financing?" So I guess he just means like deed and title stuff. But what would you require in terms of like proof of ownership?
Yeah, it's pretty easy. Just the original, like the purchase HUD or deed, and then also like additional documentation would be leases, right? That's we like to if we're originating those loans, it's really good to have it rented. At least has to be rent ready.
Okay, cool. And my very last question, I promise, comes from Keith. He says, "My company stabilizes unsafe structures into stabilized shells for developers to finish with interior finishes and new MEP systems. Would you
Mhm.
still fund this type of deal? And what terms of slash ARV of a stabilized shell versus ARV of a final renovation?" So
Got it.
and that might be better served with a conversation between the two of you. It sounds like a
Yeah.
niche sort of development.
Yeah, Keith, I would love to talk more. I would say it sounds like maybe that's a bridge only product. Like we wouldn't fund only a portion of a project to not completion, but maybe it's a bridge only. As long as it's not pure land, we would maybe do a bridge only. But I'd love to talk more, man.
Great, cool. All right, Chris, now let's handle contact info and websites and stuff. I'm going to type it in the chat. The
Cool.
iFundCities website, is it just all or iFundCities.com?
iPhoneCities.com. Yes, you could also find us on Instagram at iPhoneCities. And then what's the best way, Derek? You tell me to give, my personal, it's just Chris
Yeah,
at iPhoneCities and our phone number.
cool. Chris at iPhone. I'm just going to put it in the chat here, and then in my email tomorrow, I'll list that out. And then, Chris, anything you want to share with anybody, just feel free to pass on to me, and we'll make sure everybody gets it.
Awesome. And then just sort of like parting words, which I always like to share. It's important to, again, build your team. And one thing to realize is that all lenders suck. We just try to suck less, everybody. It's an imperfect system. So you work with a lender that that you trust, that can execute.
Cool. That's a good note to leave off on. Thanks, Chris.
Appreciate it.
So let me pull up my screen with I'm just gonna promo the next couple JUMPinars we have. Give me a second. Can you see my screen now, Chris? Cool.
I got it.
So our next JUMPinar is going to be in person at our office in Germantown. So check the website, jumpstartgermantown.com/events to find the address and the dates and times and everything. The topic is going to be how to think like an appraiser with a Jumpstart graduate, Cameron Foster. He attended our fall 2024 program and has a lot of experience appraising in the city of Philadelphia. So he's going to teach us how to think like one and how to, work with an appraiser to get the appraisal you want, not just, what they're going to give you. And the next question or the next event we have is financial preparedness for investing, and that's going to be sort of planning your like Chris was saying, your equity and planning, sort of how you're going to approach financing your next deal and whether you're ready and what the 5-10 year plan of your finances is. And we're going to talk about how to prepare yourself for making this really big decision of investing in real estate with our speaker Kenneth Wilson, and he's I forget the name of his financial group, but they're a financial education group, and they're going to come join us for a little virtual webinar on the 20th. And lastly, all the JUMPinar recordings are online at jumpstartgermantown.com/library. We're slowly, very exciting, moving over to YouTube. So if you go there and at the top, you'll see a YouTube link, and we've got some of the recordings up on a YouTube playlist. But you can find like over 70 or 80 hours worth of content on the website. And we'll also have this available as a podcast episode probably in a couple weeks. So look out for that. But Chris, thank you so much. This was excellent. I really appreciate you spending the time tonight to educate everybody, and hopefully a lot of jump starters reach out with projects.
Yeah, no, I appreciate you, Derek, and the rest of the Jumpstart team. You guys have been awesome. Looking forward to working with you guys and everybody in the chat. Looking forward to seeing you on your 10th deal. All right.
Great. Awesome. Thanks, Chris. And Marcella says this was very insightful. Cindy says awesome information. Thank you. So good feedback. Thanks, everybody. Appreciate
Awesome.
it. And we'll talk soon. See you,
Love
Chris.
it. Have a good night, guys.
Hey, everybody.
Have a good night.
See you, Paula.